This is the Norris Group's Real Estate Investor Radio Show, the award-winning show dedicated to thought leaders shaping the real estate industry and local experts revealing their insider tips to succeed in an ever-changing real estate market. Hosted by author, investor, and hard money lender, Bruce Norris.
Hi, thanks for joining us. My name is Bruce Norris, and today our special guest is Daren Blomquist, Vice President and Market Economist at Auction.com. What chart do you look at to say that's a domino chart that's going to create a negative reaction that's going to have some legs and cause more foreclosures? Because I guess, if I'm in your business, I would like to know the events that get me there. So what do you think that event is? And do you see any of that setting up for a domino effect?
I guess I'll answer the second half first, and I actually don't see anything triggering a huge, this domino effect that creates a big wave of foreclosures going forward, at least at this point. Now, what might do that is, right now, what I'm looking at is inflation as a trigger that could eventually push the economy into recession. And we do see an uptick. It's probably not surprising, an uptick in the distress market during and after not just the last recession, but if we go back to previous recessions, we see that increase. So that's certainly anything that would trigger some type of recession. Even if you don't see home prices decrease much or any, we do see consistently an uptick in delinquency and foreclosure during previous recessions. So that's what I'm looking at right now. I think is a domino, is inflation going up, pushing the Fed to become contractionary in their monetary policy, which pushes at least the economy toward recession, if not into recession. And I guess the way I'd say it is, like, I think John Burns has done a good job of explaining how right now it doesn't look like 2006 as much as it looks like maybe 2001, 2002, or at least it's setting up a scenario that could look like 2001 and 2002, where it's not the pandemic and the pandemic recession that triggers an increase in the distress market, but it's the response to those that could potentially domino into a recession down the road.
Okay. Have you looked at, you joined the party in 2000 approximately. Have you taken time and you just mentioned a couple, have you looked back at other California, like from 1980 on? Do you see any similarities? Because they're very different outcomes. That's what's really interesting to me. And looking at the let's say 80 to 83 cycle, where interest rates were crazy, unemployment was over 10%, 25 months of inventory, and then for those 3 years we don't have any price declines, which you kind of shake your head and go, okay, wow, that's rather amazing. And prior to that, 74 to 80, interest rates go from 7.5 to 15, and in that cycle prices tripled. Median price went from 34 to 102. So that's when people say, okay, well, when interest rates go up, of course, prices go down. Well, that's a pretty big example. Said, well, not necessarily. So it's going to be interesting to see how this inflation plays out. One of the things Cal Poly did that was pretty cool during the 70s is they had a general contractor bid out the same house every year. So you could actually see the price progression of the same house every year for a decade. And they also charted the labor costs for the painter and for the plumber and all that. So what was really interesting is that while interest rates were going up, wages doubled for those people. And oddly enough, because of interest rates, they actually could afford 85% of what they could have in 1980 with their wages doubling. So inflation hurts the buying power for sure, but you know that we're so used to seeing interest rates at 2 or 3 or 4% that it might be a real shocker to have a 6% mortgage someday.
Yes, yeah, absolutely. And I have actually some of the best data that we have is in California. So,
Sure.
and you probably know this too, but you know, some of the public record data doesn't go back as far in other states as it does in California. So I've looked at that, but I can't claim to probably have looked at it as deeply as you have. But I know that there's been what we did see. One of the things that stood out in California, and you'll probably be able to correct me if I'm wrong on this, but I think it was in the 80s where it wasn't right in line with a recession. It was, I think, in the mid 80s, or maybe this was the 90s. I apologize. But we did see a price, maybe this was your California crash scenario, but we actually saw prices absent of at least very close to a recession, prices decline in California.
Yeah, that was 90 to 96.
Yeah. Okay,
yeah, about a 10% total decline from about 200 to 180. Very methodical. And what was interesting, and this is kind of so I look at all these different recessions and try to say, okay, well, what causes the price damage? So in 2009, you got a 4% mortgage rate. And you have, in 1980, you have a 15.5. You have unemployment be the same. But the difference to me was that the market became dominated by foreclosures. That was the comp. REOs were the comp. So if you look in the MLS, 80% of the volume of sales was an REO. In 1980, it was 25. So as an appraiser, you could ignore 1 comp and 4 and go, that's not the market. You can't ignore 8 and 10. And that REO became the market, whatever. So when you guys, let's say you didn't sell it, and it's interesting because there was a lot of more optimism on the lender side, not letting those sell because they were owed, here's a good example. We had a house that we bought in Moreno Valley for 64 grand that had gone for 365.
Wow.
So if you're a lender with 100% loan, you're not going to open the bid at 65 grand. You're going to, hey, we're going to take that back as an REO. And then it would go through a series of REO listing agents. So they'd say, well, let's try and get 280, 250, 150. Okay, we'll take 64. Well, when you got 64 and 8 out of 10 sales were in that ballpark, well, what's the market? I mean, it's crushed. Yeah. And then it becomes its own worst enemy because everybody's underwater. So, that's, I think when I look forward, I say, okay, well, what are the safeguards in place that prevent that this time? And I think there's some pretty good ones. So I'd like your take on that as far as what do you think would prevent a big glut of foreclosures coming?
Yeah, I mean, I think the shadow of the Great Recession is still pretty dominant in a lot of folks' minds, which is why we still have, I think, those safeguards in place to prevent that scenario from playing out again. But yeah, I think that's a really good point about the really, I think one huge difference. I mean, foreclosures are typically the exception, not the rule, and they became the rule during the last recession. And it was properties and foreclosures are typically properties that are highly distressed in terms of their condition. And that was also became somewhat flipped, I think, during the last recession. Like properties that were built 2 years ago or less were being foreclosed on, right? And not highly distressed. And so it became the market. And right now, I mean, I think I do think the forbearance program and the combination of the forbearance and moratorium were very successful in just preventing if there had been no policy put in place to prevent foreclosures, I think we could have seen this somewhat, just because everybody was so scared in the early days of the pandemic, that we could have seen this surge of foreclosures that could have been dominoed or be steamrolled into a more market-wide problem. And so those policies really did help to say, okay, let's just take a pause and make sure we're not overreacting, type of thing. And that has been very successful, I think. And even as we're seeing the numbers recover, we're not seeing really much evidence. I mean, that there's a big surge of foreclosures coming. We see this kind of steady in our numbers. We see this kind of steadily rising tide, but we're still basically 40% nationwide, about 40% of pre-pandemic levels. Now, I think there could be a danger you'll probably start seeing headlines over the next few months that foreclosures are increasing.
Yeah, 300%.
Yeah. Kind of the point you were making earlier. And that may get people a little bit twisted, but I think as long as we keep in mind that even with a tenfold increase in foreclosures right now, we'd probably be back to about pre-pandemic levels.
Yeah, which was not damaging to price at all.
No, I mean, it was a very small percentage of the market, and they were distressed properties. And really that's where we think there does need to be almost, or at least I should say, I think, I don't want to speak too much on the behalf of auction.com, but the more I see this and the more I talk to investors who are dealing with these properties, is there does need to be an outlet, especially as America's housing stock ages, for that housing. There's a certain percentage, a small percentage of that housing stock that is going to be distressed and needs to be revitalized. And that's a healthy way for the market to operate, rather than foreclosures becoming a dominant part of the market.
What is you guys, your client is basically not just the buyer, but also the lender base that says, okay, and you already intimated that they were looking for ways not to have an REO. So I guess that's what I wanted to know is what's their attitude about forbearance, making a deal, doing a short sale before the auction, all of those things to not end up with the inventory. Is that their goal?
I would say, yeah, by and large. There are a couple of exceptions, maybe and I won't name names, but clients who, not your typical banks, but the type of clients who bought up a lot of non-performing loans.
Oh, sure. That's different.
And so there's a couple of exceptions where they're looking actually to build a rental empire out of REO. Sure. I don't know how well that's working out, but by and large, most of the banks, and everything is really colored very heavily by what Fannie, Freddie, and FHA say. And those three are very much on board with trying to create the best outcomes for neighborhoods, for home ownership with these distressed dispositions. And in general, they do. They've been convinced by our argument that it's actually better for them financially and also better for neighborhoods if the property is sold before REO. So there's what our CEO calls there's still vestiges of what our CEO calls the REO industrial complex, which some of these banks, I mean, they have these big departments that deal with REO, there's a certain amount of self-interest to feed that beast. But I think that's starting to fade.
Okay. Do you find it's easier to predict trends long-term or short-term?
It's I would say short-term is more accurate, and long-term is in some ways easier because you can get away with being wrong a little bit better.
Okay. Okay. That's interesting.
What would be your answer to that?
My answer, no, long-term is much easier. Because
Yeah.
there's repetitive things that happen, but I had the same opinion in January of 2020. I'm looking at the best set of charts. And we should be going up 15%, and we're going up none. So I think there was one of the articles you referred to, realtor.com, or maybe it was Carr, talking about, basically a less than 1% price increase in 2020. And I was right on board. How could you not go down if these charts go in the wrong direction? They're so positive and we're not going anywhere. So yeah, that was actually an accurate prediction that was wrong, but it was accurate. That can happen.
Right. Yeah. I mean, there's always unknown wild cards out there, like a global pandemic that can change things very quickly.
Yes. Well, there's a couple of the safeguards that we have in place that weren't here during any other time, is that, we have, I don't know how many I don't know how loans have rates of 2 to 3%, but I would imagine a large percentage of whoever owns a home has a mortgage that's under 4 and it's fixed. And in some ways, have you found that they're staying there a lot longer, partly because of that?
Yes, in the data I've seen, the average home ownership tenure is definitely longer, and I think that has something to do with it there. And on that topic, I just bring up, a safeguard that a lot of people talk about, and I agree with generally, is the homeowners have an unprecedented amount of home equity right now.
Right.
That should be a cushion against foreclosure for sure. But one of the puzzling things, I don't think that's as ironclad as people think. I definitely think it's a factor that's helping and is a safeguard. But we do see in our own data that's puzzling is that there's these properties that go to foreclosure auction, and about 20%, about 50% of them, and that number has been increasing over the last 10 years, gradually increasing. But as of this year, about 50% of those foreclosure auctions sell for more than what's owed on the mortgage. So in other words, those are surplus funds. If we build in like a 20% cushion there, because you may have a second mortgage, or even if you sell the property, the cost of hiring an agent, all that takes out some of that. We're still seeing about 20% of the properties that sell foreclosure auctions sell for at least 20% above what the total debt is on the mortgage.
Yeah.
And that's always been a little bit puzzling. Like, why would these folks, these homeowners, allow the property to be foreclosed on when they have equity? So I think it's not, I don't have maybe you have some thoughts on that, but I'd love to hear them. But certainly equity is not always a savior for.
No, especially, the makeup of somebody in foreclosure can be, I'm going to deal with it tomorrow. And then tomorrow is the day before the auction and it's too late. So a lot of times they avoid any solution that could have helped them. You're right. So any listing agent in 2021 could have listed their home and got them out, at a retail price. and they wouldn't have had a trustee sale. But a lot of people don't get out of their own way. That's part of the foreclosure business, that's for sure.
Mhm.
Well, so what, we talked a little bit about inflation. What do you actually think we're going to see that do to interest rates? Do you have any take on that?
My take is that, and I don't claim to have studied this extremely hardly, extremely deeply, but yeah, my take is we are going to see that push up mortgage rates. We're already seeing evidence of the market anticipating the Fed raising rates and mortgage rates going up. I don't know what they're at exactly today or anything, but yeah, that's the general trend. I would expect to see those rise. I mean, I feel like there's been a lot of folks who have predicted that mortgage rates have to rise over the last few years, and I know that you were contrarian to that a couple of years ago when I heard you. I think you were predicting mortgage rates.
That's would start with a 2. Yeah.
Would start with a 2. Yeah.
Yeah. When you put that on the front of a cover of a report, you're stuck with it. Yep.
Yeah.
Someone recently asked me if I thought they go down to 1. I said, I'm not going to put that on the front of a report.
What do you see on that front? I'd love to get your input.
We've just spent the year talking to people that are brighter than myself on this topic of inflation. And of course, they disagree with each other. So that was a lot of fun. And some of these people are the brightest of them, and they disagree with each other. There's a book that I read that kind of helped me see a bigger picture than just what's happening right now. First of all, we're dealing with 9 months of inflation? The 70s were 10 years of inflation at 6.5+%. And now we have 9 months. So and why did that happen? It probably happened because we had trillions of dollars shoved into the marketplace. And there were 2 urgent groups. There were people that were urgent to stay home and pull their house off the market. And there was an urgent group that said, I have to leave where I am, whether it's a rental and now I have to own, or I'm going to go from a location that I don't have to stay in anymore and move. And all that pressure put all these prices up. But that you could see a case for that was driven by all these trillions of dollars that were shoved in. If you're a boat dealer, you're a happy guy since about June of 2020. Everybody owns a boat or a piano, I've been told. I mean, all those accessories to life that we were putting off, we decided not to put off, including the room edition and the office edition. But this book was written by a billionaire that's in the tech world, and he's on the panel or on the board of a lot of companies. And the book's name is The Cost of Tomorrow. And it was really interesting because he said tech's job is to make things cheaper and more efficient. And there was an article in Riverside probably 2 years ago, and it explained that over the next decade, 80% of Riverside's jobs could be done with robots. And that was pretty uncomfortable. And I'm not saying that's going to happen, but when you have inflation of wages, when you decide to pay somebody that flips a hamburger $25, there's a better chance there's going to be a robot doing that next year. And so that was his point. So that's a good book to read. The other things.
The Cost of Tomorrow?
The Cost of Tomorrow, yeah. The other thing is that's deflationary that's in place is demographics. So the aging of a population and also debt levels are deflationary. So we have 3 really big pieces that are deflationary, and we have inflation. And I think, in my mind, I don't think it's going to last more than a year from now. And so, one of the reasons I think that too, the bond market, we're at 6.5% inflation, and the 10-year T-bill is 1.75 approximately today. The last time we were at 6.5% inflation, it was 10. So the bond market's looking at this going, I don't know about that. I don't know. It's past my pay grade too, just so you know.
Yeah.
It's always fun talking to people smarter than you on especially on their topic. But
Yeah.
what's really confusing is when they are on the opposite ends of the spectrum. And absolutely sure they're right. It's like, oh boy, that's fun.
Yeah. Absolutely.
Well, I think auction.com is, obviously they've been a very successful company shifting gears, because that's basically what's been going on ever since they've been around. They got into business right when the foreclosures got crazy, and they first auctioned off a new housing tract, and then they went to the REOs, and then all of a sudden they went into all these other things. So at the trustee sales, especially, and they dominated that world. That was amazing to me. So it'll be interesting to see what next. But if we don't have a big downturn coming, it may very well be that they build a new clientele of buyers.
Yeah. I'm interested to see what the future holds for us as well. But I think certainly there's an opportunity there with expanding our buyer base and the types of properties that we auction off. We have started to auction off some limited portfolios of single family rentals, and so that's a first step in that direction. But
yeah. Now, are you in California?
Yes.
Okay. Can you imagine if a builder said, okay, we're not going to sell in the last year, we're not going to sell anything until we're done. We're going to hold an auction with all the houses at one time. The net that he would have made, more than he would have made a year before, would have been crazy, in my estimation. I'll give you an example. We had a housing tract that we built in a pretty remote location, only because the market was nuts, and it was Rosamond. Rosamond's 9 miles from Lancaster. It kind of feels like it's beyond.
I've driven through there.
Yeah, Rosamond is after Rosamond. There is nothing. So it's the last bastion of a stoplight
on the way to Mojave.
For a long way. When we were building those in 04 and 05, we actually had people spending the night so they could get one of the 5 that were released. And I always thought that in my head, there was a way to auction that track at one time. It would have been amazing as to what that would have gone for. You guys are big enough to pull it off, so that would be very interesting.
Yeah, thanks. Thanks for that. If you see us doing that anytime soon, it was my idea, not yours.
That's cool. All right, Daren. Hey, I really appreciate getting to see you again. And I know we've talked plenty of times, and that's right. We did have those meetings probably once or twice a year, where I'd come in and at least give them my take of what's going on.
Yeah, back in the Realty Track days. So yeah, great to see you again, Bruce. And I'll probably be moving to Florida at some point.
Oh, really?
Well, no, I'm just I was just looking at the latest census data, and definitely migration data, and Florida is at the top of the list. Yeah.
Well, what's interesting about population gain, and see this. So this is interesting to me. California, 100% of California's population gain is births over deaths. That's it. And even that was negative. In other words, last year you lost people even with the births because you had people leaving. But Florida's population gain is 85% migrating adults. And that is very healthy for a real estate market, because those people have to live in either house they buy or house they rent.
Yep.
So
you're in a good place.
Yep. All right, Daren, thanks so much for joining us today. I appreciate it.
Thank you, Bruce.
All right.
Have a good one.
See you. All right. Bye-bye.
Thank you. Thanks, Joey.
For more information on hard money loans and upcoming events with the Norris Group, check out thenorrisgroup.com. For information on passive investing with trust deeds, visit tngtrustdeeds.com.
The Norris Group originates and services loans in California and Florida under California DRE License 012-19911, Florida Mortgage Lender License 1577, and NMLS License 1623669. For more information on hard money lending, go to thenorrisgroup.com and click the Hard Money tab.